Good everyone, welcome back to our next edition of Econ Talks. Gareth, we've looked at the latest Infometrics forecast that we've just put out, and we are continuing to see that yes, the recovery is coming. It's partly here, it's patchy, it's a bit bitsy, might take a bit longer than we first thought, but it is coming through. You look at some of the economic indicators that are emerging, there are still drivers of that recovering activity, and more will follow as we head through the year. But I think the challenge at the moment is that, again, some of the numbers we've been seeing right here and now just aren't showing through that recovery as strong as I think people would have been hoping for. Certainly not as strong as we might have expected at the start of the year. But like I say, recovery still coming, just taking a bit longer. What are some of the highlights from our forecast this time round?
Yeah, in terms of that recovery, you're right. It is taking time. I mean, it is a function of higher export prices coming through and holding at good levels. Now, 3 months ago, when we did our forecast, it was at the height of sort of tariff concerns with Trump having a Liberation Day. Those concerns, they're still out there, let's be honest, but they're not as critical as they were previously. And so we're a little more confident that while exports may be cramped a bit going forward over the next 12 months or so, not to the same degree we were looking at previously. And so expecting that sort of agricultural provincial recovery to continue to gain momentum over the next 6 to 12 months as those good export prices, good incomes continue to flow through. The other one that we're having to be a bit patient for is just the effects of lower mortgage rates as well. Now, we know the Reserve Bank, of course, has been cutting the official cash rate since August last year, and people are rolling off onto lower fixed rates. There's another half a percentage point, I think, coming through in terms of people rolling off higher rates onto lower ones. And so while the OCR may not have much more to be cut itself, those effects will continue to come through over coming months. So I think by late this year or into early 2026, you get those two keys coming through. You get the labour market starting to turn around and unemployment dropping as well. All of that together will sort of back up the high business confidence we've seen, the improving consumer confidence, and actually translate through into more real spending and real economic activity.
So we started this year, of course, with a pretty optimistic, much more upbeat view of things in January. Come through to our April forecast, we were in the midst of that tariff uncertainty, feeling the sort of pressure of a pretty bleak expectation for the economy, revised things down quite heavily. Now our July forecast, we've come moderated things a bit. We're a bit in the middle of those sort of two positions, still expecting things to get better, taking a bit more time. But like you say, more spending from the primary sector, more spending from households should support more economic activity and vitally some more of that labour market optimism that'll start to show through as people feel a bit more secure in their jobs and hiring starts to pick up. But of course, not every part of the economy is expected to see that recovery at quite the same shape or pace. What are those areas that are still going to lag behind a bit more?
Yeah, well, despite the lower mortgage rates that I talked about, we're still seeing the housing market as being pretty sluggish. And one of the sort of key driving factors of that is that net migration is still coming under downward pressure. Now, it's been a little bit patchy through this year, but we are expecting it to moderate further over the next 12 to 18 months. And that we think, alongside the fact that housing affordability and rental yields for investors still don't look great, we think that's going to be something of a constraint on the housing market and by extension as well in terms of residential construction activity. Yes, there may be a bit more building activity happening in the near term, but fundamentally underneath that, if you haven't got the population growth, you don't need to build the houses. And so pretty cautious around that outlook for construction. The other area we're cautious is still around government spending. We've seen a little bit of spending occurring from the government, maybe a little bit freer than we might have anticipated, but ultimately it is still a tight fiscal position they are looking to run, trying to get the accounts back towards a surplus, a balanced budget in 5 years' time. We have a bit more certainty in terms of government investment spending, a bit more clarity around some of those areas around infrastructure, hospitals and schools, for example, which possibly will start to flow through into more activity in 2026. The last 2 or 3 quarters we've had actually been quite disappointing on the government investment side, and it's actually a bit of a detractor from growth in the near term. But you look forward to next year, there's a lot of rhetoric around and a lot of expectation there will be more delivery coming through and possibly some upside risks to our growth forecast if that sort of wall of activity does start to materialise. That's assuming, of course, that the industry has the capacity to actually meet some of those potential demand pressures overall. So look, you take all of that picture together. I think one of the critical parts of our forecast is that if you look at GDP per capita, we're expecting GDP growth next year of 2%. That's not per capita, that's overall growth. That's not fantastic growth in 2026. It's all right. But when you look at the sort of size of the economy overall on a per capita basis, we think it'll be the second half of 2027 before you get GDP per capita surpassing where it was in 2022. And that 22 experience, I think, has sort of coloured people's expectations of what normal economic conditions might be. Let's be honest, 2022 was not normal. We were horribly overheated. We had inflation issues. We had an unemployment rate down at close to 3%. That's not sustainable. And I think we've seen that over the last couple of years as the economy has had to readjust, recalibrate, normalize, and in some cases consolidate. So, it's a case really of yes, growth is coming. It's going to be better in 2026. But gee, don't expect that 2022 party to return anytime soon because, as I say, horribly overheated during that time, and that was not normal business or economic conditions.
And that's the challenge, right? You look out at some sectors of the economy and they're trying desperately or hoping desperately to get back to that place. And it just wasn't a place that really you could get back to with any sort of semblance of normal. Trying to find the new Goldilocks position for the economy is going to take more time. It's going to be patchy in some points. It's going to take longer than we first expected. But we are trying to, again, rebalance where things lie so we don't generate too much of the likes of inflation. We don't try and have unemployment sitting at too high of a level for too long. Everything's got to balance out, and it does take some time for all of those different pieces to settle themselves on the board a bit more. That's what the latest Infometrics forecasts say, and we'll assess how they go, how the rest of the economy evolves, and how quickly that recovery moves through or not on one of our future editions of Econ Talks.